Mahesh, welcome to the Equitymaster Mint Investor Hour. Delighted to have you on the show. First time that we're speaking, so I'm really excited to know a lot about your journey and your investing style. To kick this off, tell us a little bit about yourself. And I want to go back right to the beginning. Where are you from, literally? And about your parents and the environment in your home with regards to investing in stocks or mutual funds or post office, etc.
Sure. So yeah, nice to be on this show, Rahul. Okay, so I'm from Mumbai. I was born and brought up in Mumbai, yeah, in Bandra, and come from a middle class family. My dad, he was a government servant. He was working in sales tax and kind of a small family. He lived in government quarters in Bandra East, and uh, and went to a convent school. And my dad, he was the one actually who, while he was the government servant, but he had some interest in the stock market. I mean, in those days, uh, he used to make some investments in some of these blue chip companies like Reliance, LNT, and that's where I got to know about what stock market is about. But personally, about myself, I grew up in a middle class family. Went to college. Always wanted to be an engineer because in those days, either you became an engineer or a doctor, right? Those are the only two things if you really wanted to succeed in life. So I was very clear that I wanted to be an engineer because good at analytical skills, good at math, and I in fact had some interest on the technical side, especially in electronics and computer. Though it was early in those days. This is what I was talking about in 1985, and so I joined VZTI, which is the premier institute in Mumbai. Did my electrical engineering, and then worked for a couple of years and then decided to really okay, to broaden up the horizon, really, right? Because what I thought engineering would be, right, and the kind of job, but I thought it was better to open the horizon and look at other avenues. So I did my MBA. I did my MBA from Jamnal Bajaj Institute of Management Studies in finance, and immediately that was a period where India was going through this phase of globalization event in 1992, right? Remember, India went through the major crisis, right, where you had this widening current account deficit. Okay, which had actually government had to pledge its gold. I mean, the situation was so dire, and that's the time there was big reforms which happened. The first big reforms were the globalization and liberalization which happened. So I was in that era where I was in college, okay, doing my MBA, and that was a market which opened up a lot of possibilities. And it was also a time when I was doing my MBA, while I had some inclination on the stock market because my dad, he was not an active investor, but he always used to tell me about investments what he had made in the past and how they had grown. I mean, he just sat on those investments. He never really traded on those investments. So I had a brief glimpse. I remember talking about Castrol, okay, investment which he had made, and how that company continued to give bonuses year after year. And a small investment of just about 50 shares had really grown over a period of time, and they continue to pay high dividends. So that was an area which always fascinated, but I was really exposed to that. It was during the when I was in college, right, and that's the time when the Harshad Mehta bull run really was in its full swing, and that's where actually one got fascinated by. I mean, that was the first taste towards actually investing into stock markets, and the kind of gratification. I mean, that point in time, remember the markets really ballooned up in a matter of just 6 months. Okay, it went up more than double, and you thought that you were a great stock picker, right? You invested into something, and that suddenly moved up. And you used to discuss with friends, okay, this is an idea. You thought you had done your own research, and the stock reaction was a function of your intelligence and knowledge of stock picking. But really, that was a intoxicating period, which really got me into kind of investing as a career, and that's what I decided. Okay, during my MBA, that's what I pursue and wanted to really get into investing. And it was very early days in 1993. Okay, when I passed out, there was no really any. It was very early days about all these asset management companies. There was only one or two. I mean, UTI, probably, or SBI. Okay, and there's some of these PSUs, asset management companies were there. But I was clear that I wanted to start it from uh, as an analyst, and that's what I wanted to really pursue and try to do after my MBA. I mean, I couldn't get what I wanted initially. It was more about getting into project finance, right? How do you? I worked with my first job after MBA was in Tata Economic Consultancy Services, which in a way was good because that actually taught about how to really evaluate companies, how to do a proper analysis, especially when you are lending to a company, right? How to do the detailed financial analysis of that, and also how to do market surveys, how to really go about in the market and do surveys if you're launching a new product. So it exposed me not only to on the marketing side, really how to really analyze any new product when you're going to the market, how to do market research, but also analyzing balance sheets and evaluating companies for lending purpose. So that was an interesting experience there, and then I moved out into equity research, right? So that time there were very few firms actually who were doing solid research. So I joined Parag Parikh Financial Advisory Services after 2 years coming out of college, and that's what my actually interest towards the capital market started.
Yeah. So I just want to go back to your dad's stock picking. So I'm assuming he didn't have any formal education on stock picking, but he seems to have picked up all the right stocks.
So I think it was probably easy in those days. You only picked in some of these blue chip companies, right?
By
Yeah,
default,
yeah. Whether it was, I mean, Reliance, okay, was one which was the most active, okay, where
in the
I mean, that was a cult where a lot of investors in those days, a lot of retail investors actually, okay, gravitated towards that. But I think probably it was also his interaction. He was in sales tax interaction with some of these corporates. Okay, they would have some insights, and he would have just picked up some of these blue chip names. I mean, without any formal research, and just sat on those.
yeah.
So
On a lighter note, are you still holding on to some of those shares?
yeah, I think they've still been there. My dad's investment, like, he never really sold those, so they're still continuing, and they continue to really reward, right?
Yeah, the
So
names you mentioned are all like still around and doing very well. Yeah.
yeah. So I think that's the beauty. I mean, if you are investing into a big global multinational company, right, the chances of doing well, I mean, chances of failure are much lesser because I mean, now we have so many companies coming up with IPOs, and some of them down the line we don't even hear their names.
That's right.
But I think if it's already established company, a global major, I think MNCs, if you look at in those days, I mean, they were huge wealth created because they had the muscle power. I mean, financial power muscle was there, but they also technology and products, okay, which they had tested in their home markets, and they could really get into India, and India was a growing market. They had the right management in place. So I think those were the stocks which were the most companies which had a huge amount of longevity, and they continue to grow as the Indian economy grew and really rode on that.
And I think this is some point we'll touch on later. Uh, Even though they tended to be the more expensive stocks, they still were amongst the biggest wealth creators in time to come. And that is the irony. You didn't really have to take all that much risk to make all that much money in stocks if you just followed these basic principles and stuck to the blue chips and did well. Uh, the other thing you mentioned, which I found interesting, is you went to college. You were in Jamnalal in '92. You're are you still there?
Yeah,
Or
I graduated in '93. Yeah.
So Harshal Mehta had an impact on you, like you said. Everything was, the first. I think, if I'm not mistaken, is that stat still true? That those were the years that the Indian households' allocation to stocks was really the highest at some in those bull market years. So there's a lot of interest there, and you of course got influence, and you wanted to do stocks. How did the collapse affect? Because I think by the end of '92, it was almost over, right?
Yes. Yeah.
How? What were your thoughts then?
Yeah, so I think that was very early days. I think, and the whole uh, uh, the whole bull run itself, okay, was so fascinating. And to see this thing, I think there were very small investments, okay, which one did. And I remember investing in some of these infrastructure names because that was the big theme at that point in time. The cement companies,
Replacement cost.
some of these,
Replacement cost, yeah.
and then some of the cement companies like ACC and this thing, right? They really went at that time. It was talk about all these asset plays. I mean, what a replacement cost of asset or whatever. It was all crazy stuff which was going on trying to justify those prices. But yeah, and then there was the huge crash which was there. I mean, I would not say that we were smart enough to really cash into it, but I mean, I think the whole, because since the stakes were very, very small, right, I didn't really do much. But the whole excitement in that period, the journey up and down, also created a lot of, I mean, uh, it was in a way a learning experience. Okay, that I mean, in early days, if you have those kind of big shocks, right, it always makes you much more saner, right, and makes
This
you
is
much
the fee.
more
It's
wiser.
the fee you have to pay.
Yeah, I mean, it's all. I really believe that market. There is always a fee. Any losses you make in the market is the fee you pay for learning, and if you don't learn from that, right, okay, then that this thing is got wasted. Otherwise, that's an investment which you do, even if you make a loss.
So, which was, if I had to ask you and put you on the spot, which was the one thing you took away from the Harshad Mehta spike and fall? What would that be?
So I think the one takeaway is that I mean, you can't make easy money, right? I mean, whenever you see that you can make easy money and too quick and too fast, then you have to be careful that something is wrong, right? It can't it be so easy, because if that is the case, then everybody would be really rich, right? I mean, you don't do anything else. So you have to be careful, be on your guard, and try to look at, because anything which goes up sharply has to also come down, and you've seen that not only in that period but even now also, even today also, that is relevant, right?
Yeah, yeah.
So you have to be really cautious, okay, question, right? If something is really doing well, okay, if you're making investment, it go too fast, just question the fundamentals over there, right? Because the price, as Warren Buffett says, right, stock market, the price is like a is like a is a voting machine.
It's a
Yeah, it's a
voting
voting machine, right? How many people are saying, but in the long run, it's a weighing machine. What's the value, what it is, and that is what ultimately it will gravitate towards. So I think easy money, quick money. I think even you should be careful. Like we've seen recently in bitcoins, right? A lot of retail investors, a lot of small investors went into that because of the fast returns what we saw in the Bitcoin space, and then we've seen the crash also over there. So I think that's something which is a learning which I think came in that period, and it happened very fast and very quick. I mean, I've never seen that kind of a quick move and collapse.
And then, which year did you graduate from Jamnal Al Bajaj?
This was in '93.
93. And
Yes.
then I think 93 was the year that the foreigners, at least the foreign mutual funds, started talking. And 94 was Morgan Stanley, or was it 93?
Yes, yeah,
Uh,
somewhere around that time. Yes, that
somewhere
was
around
December
that time.
16. Yes, yes,
So
yeah.
you graduated with ambitions to do something in the investment world. And suddenly the world looked a lot more different because now the foreigners were coming to India. And you
Yes,
went to and you joined Parag Parikh at that time. And Parag
yes,
Parikh, of
yes,
course, like you
yeah,
said, is one of the venerable research houses of India.
right, right.
That how was that experience? And talk to us a little bit about having worked with Parag Parikh. I don't think uh, the current generation of investors knows much about him, but he did some great stuff, right?
Yeah. So I think it was a more of a boutique kind of a research firm house, which was at that point in time there were a few of those boutique, and there was to we used to cater to some of these foreign investors also. Like there were a lot of emerging market funds which were starting to look at India, and we had a pretty good team. We had a research head, Mr. Amarnath, who was there, who had come from IDBI. He used to be the I think IDBI at that time was a really premium institute, right? I mean, where largest which used to do on this project financing, and he was the one who used to drive our research, and that really ingrained me in terms of doing fundamental, because no matter what theory you learn, actually, okay, when you actually go down and start on the field and doing research, that's a totally different experience. Yeah, you meet companies, you analyze them, you research them, you make your detailed financial models. So that I think it was really hardcore research, okay, which really set the foundation of evaluating companies and 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 looking at from various aspects, not only these financial aspects, but also from a managerial side and also from the technology side. And working with Parag, he was a classic value investor, right? Always very cautious. Okay, he used to always look at the risks, okay, which were there first. Okay, then look at the company. Also, at that point in time, we used to have. He used to also invite some of his influencers or friends, okay, who were into the market, personal investors who had good invest. I mean, they have invested their own money and learned from those experiences. So there was a gentleman, Mr. Chandrakant Sampath, who used to uh, come to our office, and he used to also mentor us and teach us. And he used to talk about actually that point taught us about the value of the intangible values, right? About brands. Like, I mean, he talked about a company. I mean, even if a company is expensive, okay, why is it a good company? Because it has brands, which is a strong moat, right? Which you can't really value it in terms of earnings, but that gives you the pricing power, that gives you the competitive advantage, that gives you the ability to really stay in the market and continue to grow. So that's what he used to tell us. He used to give us some of these books, right, to read about investing, basic stuff. So I think that was also a good exposure, okay, which helped me actually, okay, to be able to have a very rounded view when you're investing into a company, not just financial numbers which you look at, but other aspects, intangibles which are there, which also finally decides, okay, why somebody is willing to pay such a price or a premium. And he was a great follower of some of these brand companies, and which are not uh, highly I mean high growth companies or exciting, but they are very good compounders. And in those companies, because of the high cash flows what they generate, and and the kind of payouts what they make, if you hold on to the investment for long term, I think you make reasonably good returns. So focus on cash flows, looking at those, looking at dividend companies which are paying out dividend and returning money to shareholders. All these things, aspects, okay, were really part of the learning, okay, which I think probably learned at Parag Financial Analysis Services.
So you two things. One is you mentioned Chandrakant Sampath. So wasn't he popular for having owned large chunks of companies like Hindustan Lever, Colgate,
Deloitte, yeah,
all
okay, yeah.
MNCs, which
Yes,
have brands which are even today they are kind of irreplaceable.
right,
So yeah, that's again, like you gave the example of your father, it's pretty similar, right? You
yeah,
buy big companies which have resources, products, exposure, staying power, and this is what they do. You mentioned cash flow, and I think cash flow has become so important. It has always been important, but even more so important because uh, if you looked at cash flow uh, also, or maybe as a primary tool, it's a very easy tool to detect fraud in companies or sidestep where there's a lot of window dressing.
yes. So that's true. I think many times you get carried away some of the companies which are growing very fast, the PNL, EPS numbers, but they are not, they're actually burning cash, right? And not because finally the value of intrinsic value of a company is a discounted value of the cash flows, right? Free cash flows, because that is the money which is available to the shareholders. So yeah, so I think not just looking at the profit numbers, right, but looking at the cash flows would give you a good insight into the what is the actual money which the company is throwing, which is available to the shareholders. And I think that also helps you to really, as rightly said, looking at a lot of the window days dressing which happens, and companies actually uh, putting more capital, okay, to generate profit, but not generating enough return on capital, right? So again, the focus on return on capital also, right? I mean, ROCE, return on capital employed, which is there, is also very important. And I mean, always look at companies which are generating reasonably high return on capital employed over the business cycle, right? Because there are certain companies will go through business cycles. So I think those are some of those basic hygiene factors, okay, which one needs to really look at when one is investing in any company.
Yep. So then, mid 90s, of course, was the big IPO boom. Were you any experiences from there? The
Yeah, I think those were the big.
IPO.
I remember one stock, okay, Timken India, right? And this was one company which I participated as a normal investor, right? And oh my God, I mean, those times it used to be like crazy. I mean, the subscription was so huge. And it was like a lottery, right? If you
Okay.
got, I remember that. It was, it would have been oversubscribed by more than 100 or 200 times, right? And I was fortunate enough to get that one whatever 100 shares of that point in time. It opened at a huge premium. Obviously, later on it subsided, but that was a period where, your application form is to go at a premium. There was shortage,
Yeah.
right? You have to fill in
Famous
application
Morgan
form.
Stanley growth fund forms. Yeah.
Yeah. So sometimes you have to pay some premium to get an application form to fill in. But yeah, that was a crazy period where we saw huge amount of interest in IPOs, crazy retail money chasing that, and crazy valuations also, because depending on, people were just, if it's a good company, a great company, a unique company, then everybody wanted to really participate in that.
Yeah. Yeah. Any other recollection? Any learnings from there, from the IPO boom? Did you get caught on any one of the stocks? Those, I think there was the NBFC IPOs were also very big those days, right?
Yes, they were. Unfortunately, I didn't really get into those NBFCs because I was somehow didn't really understand those companies as well, and didn't really see, how to really value those companies at that point in time. And yeah, there were all these small NBFC companies which were there, and they were also pretty exciting. There were a lot of interest over there, but then they had a very quick death actually down the line. But I was always fascinated by companies which were probably more engineering oriented or something, had some technology base to it, and that's probably coming in from my background being an engineer. So I think you always try to gravitate or look at where you find the comfort, where you understand or you relate to it much better, right? So actually, my early days, I invested in companies, some of the engineering, which were very good, like companies like Raj or Thermax for that matter, right? And the Siemens. I think these were the companies which were very good in terms of their technology capabilities. Some of these were MNCs, and they did very well in that period, because that was a growth period for a lot of capital good companies. Like India was growing, there were a lot of investments which was happening. But fortunately, I didn't really get into these NBFC boom at that point and really and
Good for you.
yeah,
Good for you.
yeah.
So, you mentioned something which it's interesting. So, do you genuinely believe that the engineering background that you had has helped you in your stock picking process, especially of companies which where you need to study the technology or the engineering companies?
Yes, in fact, I started off my analyst career, okay, as a capital goods and engineering analyst, along with telecom and probably other sectors like cement. So sectors like at that point there was very little knowledge about some of these engineering companies, whether it was Siemens, ABB. And being an electrical engineer, I had probably at least better understanding of their products. What do they make, right? What are the applications? What are the areas where they could really get into? And that really helped me to really come out. I remember when I was there later on, I joined Motilal Oswal Securities, right? It was in '96, right? And I was one of the analysts who actually did detailed reports on Siemens engineering and did roadshows globally, and that really stood out very well. So I think that and even telecom sector, which I was looking at also, right? And there was a lot of this debate about where technology will really play out, right? Even later on, it was about CDMA and
Yeah.
normal,
GSM. Yeah, GSM.
GSM, right? There's a war which was there. So I think that clearly helped, I think, in terms of better understanding, because it's not about financial numbers, right? It's also able to understand how the technology will play out, what kind of competitive advantage it can give to that company, and how the company is also investing, okay, into technology to really remain competitive and creating new opportunities for itself. So it's not always, because see, I think the numbers is always in the price to a large extent. So whenever you look at a company and look at the numbers, it is always priced in, right? What is not priced in, especially in these engineering capital goods sector, it's about the optionality. Okay, what kind of a growth, which is not there in the current listing, but what kind of a growth could come in order book going forward, depending on the either the uh, the company will be able to introduce some new product or a new product range, okay, which is not currently factored in, or obviously, if the economy is also going through a different cyclical phase, okay, that can be a large opportunity which will open up. So, and also some of these companies also are looking at export opportunities, right? A lot of engineering companies in India, because of its strong engineering base, add an export, which is not really captured currently, but if they're able to do that, that provides another optionality. So I think all the optionalities which are there, which are where you get the surprise in terms of stock returns down the line. And that is not there
A
in the
deeper,
current financials.
yeah, and you need a deeper domain expertise to be able to gauge that.
Yes.
Otherwise, you're just reading what the management is saying, but you could actually go one level, two levels deeper and actually understand what's happening. Yeah, I can see that giving an edge. Uh, but there are not many examples of this, right? Where uh, where the really successful fund managers have deep domain experience in sectors. Yeah, am I right in that?
People have, like, for example, yeah, I mean, there is some area where actually you specialize in. I've seen that, like in pharma, for example, fund managers, okay. In pharma, they would have had a domain. So you have one or two domain because of your natural, you might have, you always start a career as an analyst, right? So there'll be two or three large domain where you would have a strength. And then as you grow, as you start managing funds, whatever, you start to gain expertise across sectors. But you need to have few domain on which helps you and certain market conditions will fall upon, right? Where you can probably have an edge, okay, to outperform.
Yep.
So I think there are quite a few, right, who have certain domain expertise, which helps you to really fall back upon your comfort zone, right, when things are not really working around.
So one area where you could really use your expertise was the whole TMT bubble that happened, 99 2000.
Yes, in a
All
way,
about
yes,
technology, all about, all the stuff that
yeah.
is learned in college. How did that play out for you? Were you still at Motilal those days, or you'd moved on by then?
No, I was still in Motilal, okay, until 2000, okay, and then in 2000 I transitioned, moved to Reliance Infocom. That's the time when they were doing their whole telecom project, right? They were just starting it. So that was just around 2000 actually I moved, just during that bubble. And probably it was fortunate, unfortunate. Okay, I got pretty much into the dot com bubble. Yeah, invested in all these technology names, and and it was pretty exciting again, similar to what Harshad Mehta, some of these stocks really moved up. And but since I was transitioning and moved into Reliance and got stuck, I really didn't bother about those investments which I had done. And then we saw the big crash, okay, which happened. So I think learning is if you don't really follow, I mean, whatever investments, if you're not able to track those and follow up what's happening over there, then that can also, I mean, you would not know when things turn around, right? And to be able to move out of that.
Yeah.
So that was a period where, again, on the IT side, people thought you knew a lot about IT and technology, and you were investing in some of these companies which were really great companies. But again, there were a lot of froth which was there, and a lot of these companies were not really great companies. They were not really generating cash flows. So I think you sometimes you think you know, right? And the market reaction, okay, of the stocks, you think that you are probably understand the technology, you understand what they are doing, and that's what is driving the return. But it's not always true. Then you realize how shallow your understanding is sometimes, right? It's more superficial. You have to really get into the companies, understand, which probably we don't do as much, right? Because you're not really into it, or you're investing really from a more distance, not really analyzing the company and taking a much more closer call. Because I mean, at that point in time, I was not a fund manager. I was just not even an IT analyst. It was just about investing in the say the TMT sector based on some basically very basic uh, initial understanding of those companies and what they were doing.
You could put your engineering skills and etc. to test at that point.
Not really, not really. That was totally different. IT was a totally different
Do
ball
you
game.
remember? Do you remember any stocks from then, which you got right or which you think you should have totally avoided?
I don't know. I think we got a few stocks, okay, which was right, right in the sense, okay, it went a like visual stock, okay, which was there. Again, that was a company, okay, which was doing good stuff, right? But again, some of these companies give too much importance on the balance sheet and other aspects, and then we saw a big fall, okay, in some of these names.
Yep.
So yeah,
Okay.
but I mean, I don't remember. There were one or two other names which I don't recollect now. Yeah.
Okay. So let's jump straight to 2008. By then you joined Aditya Birla.
Yeah, so I spent around 4 years, 4.5 years at Reliance Infocom. Again, interesting experience. Again, I was, again, after that, doing research for some time, right? Looking at the sector, I thought probably one should get some experience on the corporate side, right? And that's the time when there was a lot of lull in the market in that period before
Yeah.
2000, right? There was a lull in the market and nothing much really happening. And this opportunity came in with Reliance Infocom. I thought it was interesting because telecom was an emerging sector at that point, right? And I was a telecom analyst. So what better way to actually be with a company which is doing that at the front and trying to redefine the whole telecom space. So that was an interesting experience before that, which helped me to really see a company grow up from scratch, right? In the initial stage, trying to really build the strategy, then go into what technology to really evaluate, and then also go to the market, right? How to really go to the market strategy and then actually go to launch and execution. So I see the whole journey over there, which was very exciting. And then I joined uh, Aditya Birla Sunlight Mutual Fund in 2005 because that's the time when I thought, I mean, I didn't really plan to be in the corporate sector for too long. Probably I said, okay, 2 years, and then I'll again come back, take some experience over there. But when you get into a company, especially a company which is into its whole, and which is the way Reliance, they were executing the whole project, you get caught into a lot of stuff. You move, do a lot of different roles. It's not a very defined role. You sometimes got into the initial project evaluation stage, then into the go-to-market strategy, then product designing, then also later on funding, right? To go and raise money from PE investors. You worked on that, so you got involved in multiple roles. And I think once the project was launched, there was nothing much really to do. That exciting phase is really the initial stage, and that's what I thought.
Were
Let
you
me
were
get
were you
back into investing.
were you
Yeah,
part of the famous monsoon hangama that
yeah, yes, yeah, yeah, yes. We was pretty much part of
that
the whole
was the
scene.
offer, right? Wasn't that the offer that really got those millions of subscribers and changed everything? Uh,
Yeah, you're right. I think that was a very exciting offer. That I mean, that was the very defining moment, right? Trying to reduce the cost of ownership of a mobile phone, right? Not only the tariffs, but also you could get a mobile phone bundle, right, in that plan for say 500 rupees, and that was a huge response. But again, the challenges and execution was a problem, right? When you get such a large response, it's also about execution, how we're able to fulfill that, and that's where there were some initial challenges in terms of trying to really meet the whole expectations. So I think sometimes while you do all the planning and all the back end, but unless you have really thought through everything, and if the offer is good, exciting, but if the experience otherwise is not that great, then
and yeah,
it
yes,
is
you
not
call
such
it.
a then then that leaves a slightly bad taste. But I think the way I learned there was about how you can really able to disrupt things. I mean, that was the first big disruption which was there in the telecom space. I mean, you have to think totally radical. That's what I learned at the Reliance Group. I mean, you don't take things for granted. You really want to disrupt the conventional rules and think big. I mean, tariffs, okay, which came down from around 20 rupees down to around, say, whatever, 1 rupee. I mean, and that was crazy, right? So how do you really do that? And how do you then work backwards? Say, if you want to arrive at that, then you work backward. What should be your cost, right? How do you procure equipment, capital? How do you negotiate with your vendors, right? To bring it down. And then how do you build scale and size to really work? So you all work backwards and then try to use. So I think so that was, I think, a big way of trying to think big, trying to disrupt the market, and then working towards that and making that change. I think that was, I think, which was a big learning in the corporate side. Okay, when I was working with Reliance
And
Infocom.
then of course you went to Aditya Birla, and so those days I was researching mutual funds as well, and was it the Birla Advantage Fund? Am I getting the name right? Those
Yes,
days that was the fund,
that
and
was that was
Bharat,
in 2000. That was in that fund prior to the dot-com bust. I mean, that was the largest fund and being the most successful fund which was there, right? The Birla Advantage Fund.
yeah,
But I think in the dot-com bust, I think it got stuck over there in some of the stocks. And the
mhm,
crash which happened couldn't get out. I mean, and that was a big learning actually. because the concentration which one had in a few sectors was huge. And in the IT sector at that point in time, the fund would have exposed almost 60% in IT sector, right? And that happened primarily because the stock prices went up. It wasn't really started off that way, but the way the stock prices zoomed up, the concentration increased, and then one didn't really recalibrate that or try to diversify that or whatever. And during the crash, there was a big fall. And I remember the NAV going down below 10 from
Mm.
almost like 89, it was like 90% fall. I mean, that was a very big downfall and made a very bad taste with investors. So that's why the period from 2000 to 2005 was a period where Birla Mutual Fund went through a pretty much crisis or from the top down, especially on the equity side. And that's where debt came into focus and started being known as a debt fund house.
Yeah.
And when I joined Birla at that point in time, very interesting. I think it was known for the debt. I mean, the whole equity aura which was there had gone, right? And that time, Birla it was a capital. Capital was a partner, and then Sunlight came in I think around 2000 or so as a partner. So you're right about the Advantage Fund, okay, which was a kind of a big name, but it had an equally big downfall also prior to that.
Yeah.
So
I think that sell-off was a big learning for everyone, because that was the first time you realized if you had over allocated, you couldn't exit the position. You had to
you don't
write it
exist.
down all the way.
Yeah.
Yeah.
I mean,
So
so that
Bharat Shah was the CIO even then, or he had moved out by the mid 2000s? I don't
no,
know.
I think he was the CIO then. I think, and then probably he moved. Yeah, he moved out after that. But yeah, but I think so. Those are the because nobody had seen those kind of in the organized game, those kind of performance. So I think, and mutual fund industry was going through its learning phase. I think so. Even for me, when I came over here in 2005, joined over here. For me, the big learning was the whatever the global financial crisis, right? I mean, okay, which was again a big or suddenly it happened. So each crisis actually teaches you a lot, right, and helps you to really uh, strengthen your risk management processes, right, which are there. But yeah,
So you mentioned the great financial crisis. How did that play out for you? By then, you were at Aditya Birla, you are researching stocks. I don't know whether you're still managing money at that time, but how did that play out for you?
yeah. So I think when I joined, like that's an interesting time when also they had acquired Alliance Mutual Fund, right? So Samir Arora, which
Alliance
is
was
like
another debacle
another
of
successful. Yeah, it was a big success, and then yes. So actually, in fact, we acquired and I started managing those funds because those funds had a very good strong track record, right? They had done wonderfully well with a huge amount of returns, and 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 so fortunately we acquired those funds, right? And by the time I joined in Birla, I started managing it, and some of the Birla funds because of the the past experience, okay, were not able to sell them, but the Alliance fund actually when we got into our fold and we were able to scale that up very big. Some of these funds, whether it is the Alliance Equity Fund, it became the Sunlight Equity Fund, the Alliance Balance Fund, okay, which was there, which became the last 95. In fact, a lot of our funds, okay, in the last 10 years, 15, since then, are the funds actually which we got from Alliance and been able to scale that up, right? So,
if I may add, that story is played out twice before in India. The
right,
most successful Templeton funds came from Kothari Pioneer, and the
yes.
most successful HDFC funds came from Zurich
So,
Mutual Fund.
yes. So sometimes the acquisitions and the track record, I think it becomes a big turnaround for you, right? Which you're able to picture with the past and then move on that. So I started managing some of these funds. I was also, and in fact, in that those days, we used to double up as and research analysts and fund managers, right? We didn't have a very large team. And incidentally, when I joined Birla also, uh, most of the team had left. There was virtually nobody, right, on the research that we then had to a lot of new faces had come and the whole team building started in 2005. And that time, A. Subramaniam, okay, he moved in as a CIO, right? He was been an old hand at Aditya Birla Mutual Fund, who was there as a trader, then he went into sales and then came into investments. And that's how the whole team building started at that point in time. And we had a very good run. in that period until the global financial crisis, right? And that's the time again my strength came into play, right? That was a period where a lot of these engineering, capital good infrastructure did very well. You will remember that, right? In that because that was a period, big boom of capex boom. That was from 2003 to 2008, or it was a big capex boom which was there. And since I had and I had not managed money when I came in, right? I moved for the but since you had that comfort zone and you knew some of these sectors, engineering, capital goods sector, telecom sector also was doing well. So you could quickly get in and get some quick success over there in the funds. And by the time you learn some of the other sectors like banking, pharma, which are not some of your, you get time to really understand those. And we had a very good run over there until the global financial crisis. In fact, we had launched infra fund and it was a huge success. I remember in 2007, 6, 7. But I think the whole global financial crisis again was a big learning, at least for me as a fund manager, right? Because at that point in time, again, while we used to look at risk and concentration, other factors, but still the whole risk is not just about concentration, right? Or sector diversification. It's also about what stocks you're investing into. Stock specific risk, there is stocks which are very highly volatile, or the beta is very high. And at that point in time, I remember the fund which I was managing, because we had to maintain some of the style bias which was there from the earlier fund with Alliance. There are all these that fund had done well because of the concept stocks which were there, right? So concept stocks are stocks which are like high growth companies, like what you have currently, right? Some of these new age technology companies, or which are very high growth sectors. And valuing the stocks is a bit difficult, right? But you're really playing the big potential and the big growth which these companies offer, and that's why these companies have very high PE multiples. And in a good market, okay, they continue to do well. But when the market crashes, or when the liquidity becomes much more tighter, interest rates go up, that's where some of these companies, okay, and nobody wants to pay for the long-term future earnings. They're going to come and say 5, 6 years down the line. So that that's the risk which is there, right? It's stock specific risk which you also need to be aware of, which was not something which we really evaluated or really looked at it. And the global financial crisis, okay, when we saw that big correction, I think some of these stocks really benefited big time and really hurt us. Fortunately, I think for us in some other funds, we were looking at, we started probably raising some cash levels, okay, after the initial fall. And that's probably because of some of the discussions which we used to have internally, right, between our debt team and some macro discussions. Not evolved to that extent, but that helped us to really cut some position. Otherwise, we would have we would have got into a hole which is very difficult to come back from. Okay, but I think that whole global financial crisis, the big learning there was, not only about risk management, I'll come to that later, but also looking at not sometimes you just living in a world doing a bottom, but also look at the macro. That's the first time when we decided, okay, we need to also understand the global macro, what's happening.
So the global financial crisis really taught us that all the financial markets are clearly interlinked, and what happens in one market can have an impact across the world. And that's the time when we decided that it's not only important to look at individual companies bottom up and the domestic macro, but also to have a good understanding of what's happening globally, how the risk appetite globally is changing. And we decided, okay, let's internally start evaluating it and have a process, okay, where we discuss what's happening globally, how is the global risk appetite changing. Okay, we also came with a kind of a riskometer, right? Kind of a score which tells us how the global risk appetite is changing. And that also, I think, macro analysis became an important part of our investment process, okay, which we now do fairly regularly, where we sit with the team. And that becomes one of the inputs for us in terms of decision making when we are constructing our portfolios. And I think because of the sharp correction, what we saw at that point in time, okay, in some of our portfolios, the focus on risk management became even more important. That's more to do with your portfolio construction process. How do you construct your portfolio? What is the active risk you take in the portfolio at a stock level, at a sector level? What is the kind of a liquidity risk which you want to run at the stock level? All these factors, I think, became very important for us to look at it, and we've kind of worked around in a framework with a proper policy uh, for fund managers, right, to work within those risk framework, and then obviously express the ideas, okay, in terms of stock picking. But that whole framework, and which we laid out somewhere in 2010, 11, again based on trying to do some back testing and research, that if you put this control, because normally when you put some controls, fund managers don't like. So they think that if you put this control, then the alpha generation will get impacted. So
Yeah.
then we decided, okay, what is the kind of threshold levels we need to keep so that we can still generate enough alpha, right, to be in, say, in quartile one, right, for without taking excessive risk. And we then came with a whole portfolio risk management framework. And I mean, at a stock level, for example, the active risk in a portfolio said we should not be more than, say, 4% for mid caps and 5% for large caps. At a sector level, also, what is the deviation from the sector we need to take? We define certain limits over there, and what is the overlap, okay, which the fund needs to have vis-a-vis the benchmark, right? A
Mm.
minimum overlap, right? So that you don't take very outside skewed bets vis-a-vis the benchmark. So we've defined those also, especially for the more diversified and larger fund, not so much for the thematic fund, where the risk appetite is totally different. So I think those were the key learnings, okay, I would say, from the global financial crisis.
Kind of goes back to your stint with Parag Parikh, right? Put risk before return. Be sure you've understood all the risk elements. You know, control your downside, I guess, right? What Buffett says, don't lose money. Basically saying, get a grip on the risk and the return will take care of itself, right?
Yeah, that's right. And I think
Very
it's
challenging.
good for investors also, I think, because typically investors are slightly risk averse and on the downside, right? I mean, that's where they want to
Yeah.
really protect themselves. And I think that's also positioning, okay, which we took, that we don't want to chase returns. We want to be more consistent in our performance. And if you are okay, if you are there in the, say, in the quartile two, right? Because normally we look at fund performance vis-a-vis your peers, whether you're in quartile one or quartile two. While aspirationally you want to be in quartile one, but if you are at least there in upper end of quartile two consistently, then longer term automatically you should be in quartile one, and that's the amount of, yeah, you take a risk in a portfolio in line with that, right? Not try to really be the topmost fund in that category. I mean, there'll be a few funds where you will want to take that risk, okay, which will be positioned that way, but by and large for the large portfolio, that's the kind of a policy framework which you would want to adopt.
Yeah. Yeah. So let's fast forward 10 years and talk about the pandemic. How are you positioned in March 2020? And I'm curious to also know, did you guys get an inkling before that there's something brewing in China? If you're tracking global and we need to be aware, how did that play out for you?
Yeah, so I think the pandemic also, I think it was, I mean, nobody really expected, I think, in terms of what proportions it will lead to. But yeah, there was some kind of inkling, okay, when we started to hear about China, okay, what's happening over there, and what could be the ramifications of that. And internally, I think our debt team, right, which we have, okay, they were more tuned to it, right, in terms of, so I think that's where the interaction between doing the macro, right, interaction with the debt team helps us to get certain insights, right, because the bond market starts to reflect that much early. So we had some insights in terms of what could happen and what are the risks, okay, which could pan out. But again, knowing that and trying to really implement taking portfolio actions is a different ball game altogether, right? So while we didn't increase our risk or whatever cautious, but I think in terms of trying to really make big changes to the portfolio, I think uh, uh, I mean we also didn't really fathom, right? Where there was lurking fear that, okay, something can go from initial fear to something worse, but but we didn't really take any drastic action, right? I mean, as a precursor, okay, to protect our portfolios. However, we didn't really also try to chase, I mean, try to reduce our risk in a way. We didn't want to increase our risk in our portfolio.
Got it.
Some amount of cash levels, okay, we would have kept, but nothing meaningful. So I think in that fall which happened, right, after the pandemic which came in, obviously everything went down. right? I mean that period, everything, even the good companies and this thing also crashed because nobody know what could be the implications of this, because the first time people experiencing this kind of a pandemic. But I think post that, I think a recovery. I think we were pretty clear. I think that the recovery also will be equally sharp, right? And the whole stimulus which was being given by the central banks, right? I mean, this time around, uh, looking from the global financial crisis experience, the central banks which were much more prepared, right, in terms of trying to infuse liquidity,
Yeah.
cut interest rates, and then we could see that all that liquidity and this thing because can actually reflate the market back, right? And that's where the macro analysis again came into play, right? What's happening? What I mean, this was the kind of a mother of all stimulus, right? The kind of injection which was done by the US, it was almost 3 times more than what it did in the global financial crisis. So that led us to take a while things are still bleak. I mean, that time there was a lockdown, corporate profits had come down, but the financial conditions became so easy, right? That we thought that the markets could reflate back, and we actually played out the recovery fairly well in that period and positioned in some of the cyclicals. We saw a big rally in the metal space, the IT sector. We were able to play that pretty well because we were tracking the global macro.
So you effectively just rode it all the way down and up.
Yes.
And then you of course made your tweaks based on what was happening, but you literally rode it. And the reason you did not exit is because there was not enough known, and therefore there was no point in exiting. Was that one of the key sort of decision making points for you?
Yeah, so I think decision-making point was that because of the whole liquidity infusion and the cut in interest rates, right? Okay, I think while there was some uncertainty in terms of how long this will last, but I think that we thought would lead to a pretty sharp recovery also when things normalized, right? We could see a big V-shaped recovery which could be there. So that was something which was there, and that's why we stayed put, okay, to our positions. And that's a time when actually we could get some good companies at a reasonable valuations. What is happening that until that period, and that also impacted us actually, a lot of good quality stocks. Okay, if you look at the period from 2000, yeah, I mean 2018, right, or 19 till 2000 till the pandemic, it was a lot of these high quality stocks were doing very well, and the valuations became crazy. It was quality at any price kind of a thing because that period there were other sectors which were not doing so well. So it was only a few stocks, okay, which had
Very narrow.
visibility.
The market was very
Very
narrow
narrow.
then.
Yeah, yeah. So the quality did very well, and a lot of the quality stocks became very expensive, and we couldn't participate because our philosophy has been slightly growth. We like growth stocks, and these were some of the growth and quality stocks, but at a reasonable price. But during this pandemic, when the markets everything went down initially, and that was a good time to buy some good quality growth stocks at a reasonable price. Okay, though they bounced back also very fast, but we could probably look at some of these names, okay, and add to our portfolio. So I think the market such crisis gives you opportunity to really buy good stocks or good quality stocks at a more reasonable price, and that's I think what I think one should do because they are the ones who bounce back pretty fast, and once your entry price is good, okay, then you can stay with them for longer.
Yeah. Goes back to the whole Chandrakant Sampat thing, right? Buy quality and just hold on to it. Yeah. Over
Yeah,
long periods of time, it
yeah,
does well. If
yeah.
you know, the
I mean,
boards
you should.
reevaluate and all that, but yeah. Mhm.
Yeah, I mean, you should also not. I mean, there are many companies, sometimes good quality stores, they go through a phase of quite stagnation, right? It's also important to evaluate and see that whether they are continuing to really,
Yeah.
I mean, in line with what's happening around in the market, because some of the quality stores also get disrupted, right? You've seen that classic cases, good companies, they don't change or adapt to the environment, and they can also fall prey to that. So I think that monitoring is still important, but you are more patient with those names, right? Because if they are doing the right things and they are and focus on the business, I think they'll be able to bounce back. If the external market is a bit adverse, they will be able to come back.
Yeah. So it's like, was it Narayan Murthy who said that? I believe in God and everyone else needs to come with data. So you can believe in all these companies, but keep verifying whether the data is right and whether they're doing the right things, right?
Yeah.
Uh, Buy and hold doesn't mean just ignore the stock. You have to still study the stock and be in touch with it and be sure you're doing the right thing. So, just moving on, just changing track a little bit. You've of course in the discussion so far, you've narrated very critical points, right? You've spoken about the importance of the return on capital. You've discussed on how it's important to look at cash flows. You've spoken about how just the superficial reading of an annual report can get you into trouble if you look at only the earnings per share, etc., and the importance of macro and all that has come in over time. So, talk to us on if I ask you, uh, what's your stock selection process as it stands now? How has it evolved? And it's working the way it's working, which is very well. So how do you go through those steps and zero in on a good stock?
So I think it's a combination of again some amount of top down in the sense looking at the opportunity, right? Where the company, what space, a sector it is, and what is the opportunity size over there, right? If it is a growing sector, right, the opportunity size is big, then you are okay to really look at that company and buy it a bit expensive also, right? Because there's a long longevity of growth. But normally you would look at sector, okay, which is probably growing at a faster pace than the overall GDP growth, right? That's the style when you're investing into slightly growth stocks, and that's what normally we prefer, right? Investing into growth sectors,
You
and
don't
then
mind paying a premium for growth, a little bit of a premium for growth,
yes, we are okay
provided
to that.
uh,
Yeah.
uh, how do you decide what premium to pay? Is it like you can see there's visibility? What goes into that decision making process?
Yeah, so I think in that you have to look at what is the opportunity, right? How the market is likely to grow, because either it could be under-penetrated market, or there could be a large opportunity with the companies trying to, like a retail company, for example, right? Move from say unorganized to organized, and then try to not just look at next 3 years, but at least try to say look at the next 5 years or whatever period you can explicitly forecast that, and then try to discount those back. I mean, DCF is one way to look at it, but DCF is prone to a lot of errors and a lot of assumptions which you make, right? So you try to look at as far as possible you can in these companies and then discount it forward. It can be next 5 years, 8 years, 10 years period, wherever you can forecast those numbers explicitly.
And when you're looking at these growth elements, you like you mentioned, did you mention formalization? Or organized to
Could
unorganized
be
to
one
organized.
example, yes.
So you're basically looking at trends which are irrefutable, which
Right.
are like mega trends which are happening in India. You can see it all around you. It's just a matter of saying at what pace that will happen. So you're trying to ride that opportunity, and you're saying because this is not a company specific trend, this is a macro trend. And if I have the right stock, I don't mind paying a little more because that growth is not totally uncertain. It's a little bit more certain because it's a macro trend.
Yeah.
Am I kind of there?
Yeah. Okay. What you're talking about is for some of these high growth companies. Okay. But normally, traditionally, you look at companies, okay, which are either growing faster than the market, right? Any particular industry, because okay, that's what most of the companies will be. You will not find many companies which are there in these high growth sectors, right? But your traditional stock picking approach would be to look at companies which are probably growing faster than the industry, because that's where the value creation will happen. And the faster growth will come in either way, because they're taking market share, because probably they have got some competitive advantage, okay, which they have, or the advantage can come in from technology, product, distribution, or cost competitiveness, right, which is there. There should be some kind of a moat which should be there, which
They're
will,
gaining market share. They're gaining basically market share.
yeah, and that could be on the basis of either a good product, okay, some technology advantage you could have. It could be a cost advantage in the commodity space, right? If you're a lowest cost producer, then you'll always survive and you can always continue to grow and expand, right? Even when the commodity prices are down, or it could come from the distribution strength, right? Which could be a moat. So there should be some element of strength or competitive advantage, okay, which is a strong moat, which will give you the extra edge either to gain market share or a better pricing power in the market, right? And the better pricing power means that you will get better returns than your competitors, or better margin or return on capital. That is something which I think one would look at as a part of the whole investment process. And then look at whether the company is generating first enough return on capital over the business cycle. I mean, higher the better, but at least there should be a certain threshold, say about 15% or 18% return on capital. And so that are some of the screeners, okay, which you would run. And then you look at the management. I think management also, quality is important factor, okay, which over a period of time you realize that that is again intangible, which is there, which can have a lot of bearing in terms of the long-term returns of the stock, and also trying to avoid mistakes. Because betting on the wrong management and where there could be public, you've seen that, right? What happens to some of the stocks.
Yep.
But more importantly, so the management evaluation also is very important, and we try to build some framework around that. Okay, how do you evaluate managements? Looking at not only some which are tangible numbers disclosed into financials, but also some intangible stuff. Okay, what past track record of the management. But I think management is, from our perspective, I think what we're looking at is also management, how well they are, how with their visionary management, okay, they can have the vision to really able to transform the business and take it to the next level. Okay, if that is the case, then that can mean that you really have a big winner at your hand. Also, how the management does capital allocation decisions, right? Where they're allocating capital in the right way, in the right areas, and not trying to, well, a company might be making good cash flows, but if the capital allocation decision is not good, that means you are actually putting good money after bad, right?
Yep.
And then basic corporate governance issues. So all these factors are also important in terms of trying to decide in terms of what kind of premium you want to pay. That's why in the marketplace we see, right, there are few companies which are having similar growth rates, similar return ratios, probably, but their multiples are different, right? And that's where the management quality comes into play, right? Because historically, companies which have demonstrated, right, market tends to give a higher multiple to that. So that's something which you try to build into your stock selection process. And then finally, it comes down to the valuation, right? Because then you have to also to buy the stock at the reasonably, you will not get it necessarily cheap, but at a reasonable price for you to make reasonable returns, right, over your investment horizon period, and especially.
Good company at a fair price is better than a fair company at a good price. That's what you're saying.
Yeah, that's right. Because over a longer term, you want to be into good company, because see, there could be a stock which could be mispriced at a particular point in time, right? And you can get that delta, okay, buy that stock and you play that out. But if it's not a good company and not able to compound, the long-term wealth creation won't happen.
Yeah.
And normally you want to buy stocks not just to buy, while you always play some of those tactical trades, stocks which are undervalued, and try to play those whatever catch up to the valuations kind of a trade. But ideally you want to buy and hold on to a stock, right? So you buy that stock and then allow it to compound over a period of time, so that you don't want to sell that stock, right, once you're bought in your portfolio. So that's, I think, where it's important to understand the long-term growth prospects of the company, and management also, how is able to drive that, okay, through the various market cycles, and also has the vision, especially now in a period we are seeing that a lot of business are getting disrupted, right, because of technology, startups. So how the company is able to really manage that or visualize and keep the company ready, future ready, so that it have a long longevity.
So just to recap your process, you're buying companies in let's say a sector, you want it to be growing faster than its peers, have better metric for whatever reason, cost control, supply chain, distribution, etc. You want companies to have a good return on capital employed across a business cycle. You're looking for management quality, which you articulated very well on how you can assess, and valuation, of course. Uh, two points I'd like to make on valuation. I like the way you say it, that you can get a mispriced stock at some point in time, but it may be, but you still want to buy a good company and ride it over a long period of time and compound with it, as against just chasing a pop, which may come because of a mispricing, because you could end up with any kind of company. On the management quality, we had a guest on the Investor Hour some time back, and he said he had notes of management for 20 years. So when when he would meet them, he could literally verify whether they're actually doing what they have said over long periods of time. And that he was trying to explain his framework on how
Right.
he assesses management quality. Because I think everyone talks of management quality, very few people can articulate it. And I'm so happy you spoke a little bit about that on how you should do it, how you should assess, have a vision, capital allocation, which is, I guess, one of the biggest decisions, most important decisions that management makes. So yeah, this is a pretty tight process. Any other element to it that you'd want to add, or which could also be considered in the stock selection process?
So I think this is for a traditional company which is there, right? And then it comes down to some of these high growth companies, the new age companies, right, where it will be a bit different, right? Where it's difficult to uh, uh, really make an assessment based on pure numbers, right? Because they are not really numbers which are there, right? Where you can look at return on capital, where the companies might not be making real profits at this point in time. So there, it's slightly different where you have to really look at more into the future. You have to look at in a different way, right? I mean, just to give you some example, like a new age company, like for example, Zomato for that matter, right? Or any other company like Nika. So there, you would want to look at what is the total addressable market. How big is the target addressable market? Because these companies are coming in with some disruption and trying to gain market share, right? They're disrupting the existing players. So what is the big addressable market? Well, that is the big picture. Because currently they might be still be small, but and losing money. But what is the total addressable market you look at? Then you see where this company has got certain already established certain unit economics in place, while they will be losing money in the market currently because they are growing, right? So they are putting money for growth in terms of advertising or customer acquisition. But have they got a model in place at the unit level? If they stop growing or they reduce their growth rate, are they making reasonable returns, right, on their investment or at the unit level? So if they have done that, right, and when they have established already a leadership, because that is very important in this space, because only one or two companies really do well, right, in the new age tech in a particular sector, because scale and this thing is very, very important over there. And whether the competitive intensity is also in place to a large extent, because if that is still not established, then the company will continue to burn capital. So then whether all these factors are in place, and then obviously whether you see the road to profitability, okay, because if the unit economics are in place and the profitability is in place, then you can look into these companies, say, over a period of, see, earlier, sometime back, people used to value these companies purely on sales multiple, right? Revenue or whatever, EV per revenues or some other multiples. But I think we would wait for companies to really reach that at least inflection point where we can see profitability, and then try to project the profits, say, for the next, say, 5 years or 8 years, and then discount that and then value it. And here also the management is very important, because here the initial promoters, right, who are driving these businesses, what is their skin in the game? What is the kind of vision they have? Because they are the ones actually, these companies are very, very fragile in that sense that it's too much dependent on that individual, right? Because they're not a traditional companies, right? Okay, which have got a very established kind of a management team processes. So I think betting on those promoters also and trying to understand, I think is pretty important in terms of what is their vision, how they are trying to navigate. So that's a different ball game for looking at some of the new age technology companies.
Reminds me of Amazon. One of the reason Amazon loses money is because they reinvest so much in their business. So if they want to turn profitable, they can just slow down a bit and they'll start making money. So the point you were mentioning, the unit economics is such that they're profitable, but just that they're reinvesting it and chasing growth. So that's a business which is just got to prove it's kind of a proven business model, and you have to see whether they can sustain that as against a business. Now I can take this name because we're talking of an international company, as against a business like Uber, where they were losing money. Right, I'm talking about ages ago. The unit economics was also a loss. There was no profit at all,
Right.
and losing then even more money in the growth. So that was like a big it wouldn't fit any model. That was only a dream of addressable market, and whether they will get there, and somehow they'll figure out to make money. They'll
Right,
do
right.
a bit along the way and make money. And be that as it may, they entered various other businesses, and which kind of did some money, made some money for them, right? Deliveries and all that.
Yeah, yeah. So I think those kind of investments are for very early stage investing, right? People who take the higher risk and bet on a
Risk return
multiple
appetite
names. You
fine.
bet on multiple companies that something will work, right? But when it comes to us, really, when we are putting public money, okay, into our fund, I think we would look at companies which we think have really all those parameters in place, and then looking at valuation, right? And what is a reasonable price to pay? I mean, that's how I think we would do our stock selection process in these high growth companies.
So talk to us a little bit about portfolio construction. Now, I know I'd like to ask you personally as against a fund manager, because in a fund, I know there are all those criteria that you all follow. But when you're thinking of how an individual should construct their portfolios, how many stocks, how should they weight it, how should they size the positions? Any thoughts on that?
So again, it's depends on individual, okay, their risk appetite, their ability to really monitor, okay, the stocks. But I would say that I mean, first of all, I think you should invest into companies if you're directly investing into it, companies where you have a decent understanding of those companies, right? You have some way of tracking it and knowing their businesses, not just based on hearsay, right? Somebody would have recommended. Many people do that. I mean, that's fine, but at least have some understanding, and that can only happen in a few names, right? You can't have at the individual level the breadth to look across, right? And you don't require so many companies, right? Because I mean, in a large fund, okay, you need to deploy a large amount of capital, right? And you need to diversify to that extent. But I think at the individual level, I think you can possibly have a much more slightly concentrated portfolio. I don't know what is the right number of stocks, because individually what happens is a lot of buy small stocks over a period of time and becomes that. But
You
at
have a
least
long tail. Yeah.
tail
You have,
could be there, but a core portfolio, right? Okay, I mean, it can be say 20, 25 stocks, right? At max is what I think would be an ideal kind of a thing, or even lower for that matter, right? Because if you look at it, it's only the few stocks which make big returns, right? I mean, out of that, there'll be five stocks which have given exceptional return over a period of time. And
Pareto principle, 80-20, right?
yeah. And then sticking to your winners is very important, I think. And that's, I think, the biggest learning here, which I see, right? There are some stocks in a portfolio which can be huge multi-baggers. And normally you have a mindset of trading, right? If you book profits, right? If it's you made it, you doubled your returns, then you would normally want to sell that stock. And then the problem is that you need to find something better, right? To be able to really replace that. But it's always better to continue with that same investment. So holding on to your winners and being patient, sometimes they become expensive, but as long as they're delivering and delivering what they are supposed to do, there's no change over there. I think you should continue to hold on to those, and that's what I've seen in my portfolio. Sometimes I've seen that lazy investing, you invested in stocks, right? And over the last, if you go back and see over 20 years or whatever, they've generated a huge amount of returns over there.
That's right.
So I think first principle is to try to be in stocks, okay, where at least you're able to monitor them, at least understand a bit, right? So that restricts your number of stocks or areas where you could invest into. Probably around 20 odd stocks. Then trying to really hold on to your winners, not sell it, because then you have to find something new, right? Which might again require a lot of
Reinvestment
effort.
risk.
Yeah.
Mhm.
And yeah, I think I think the basic principle to some amount of rebalancing can be done, okay, to some extent, right? Because something goes up quite a bit, you can take out some money and rebalance that. But I think at the individual level, you can still take that kind of risk. Like the portfolio, when you're managing a large portfolio, is much more important because you are now looking at relative returns also, right? Vis-a-vis, say the benchmark or peers, you have to manage that aspects also fairly well
The
over there.
individual doesn't have that
Yeah,
challenge.
individual have that distinct luxury, and I mean, so that in that scenario, there's some amount of concentration if it happens in a few stocks because of performance. As I said, not to sell the winners. I think that's something which I think one can still afford to take some kind of latitude over there in terms of the concentration.
That's helpful. Uh, when to sell a stock? What is a trigger that you should exit a stock?
So trigger to exit a stock will be, I mean, two things. One is if there is a change in the hypothesis, okay, fundamental hypothesis which you have bought the stock. Right? If that has changed, then I think it's important to really at least evaluate critically and see whether you need to really uh, own that stock or need to sell. Or I think that there is some big change which has happened, disruption, okay, which has happened, which is happening in a particular space, and the company is not able to really adapt to that. If you're able to see that, that could be another reason, okay, to sell a stock. Or it could be some large corporate governance issues, okay, which could come up, right? Management again, focus on management call, because if that is something which comes up, then it's best to really exit, because that will continue to haunt you, right, and affect the stock, and it starts to affect over a period of time. So I think these are the three reasons, okay, where you would want to sell. Not necessarily because the stock has become expensive, right? That could be a reason to trim down your holdings, right, or to rationalize a bit, okay, and get it down.
Yeah, you
But
preempted my question. I was going to ask you that. That do you sell because it became expensive, and that actually flies in the face of do you hold on to your winners? Yes, you should hold on to your winners, but you can always like moderately trim it over time. Because the other thing that the thing that you mentioned is there's a reinvestment risk. The other thing is if you keep selling your winners, you're only going to have the underperformers in your portfolio.
yeah, right,
That's
right,
terrible. Yeah.
right. So I think that's a very tricky question. Okay, when do you sell? Like, if stock becomes very expensive, right? It could be like we've seen during froth or bubbles, right? Stocks. But as long as the company is still fundamentally okay delivering on what it is, right? There could be some adjustment which could happen. So if stocks become expensive, there could be a period where it will go for some amount of consolidation, right? Where it, but again, it'll come back, right? So that's okay. At least you will not really, I mean, you will not really lose big money. Okay, it might get into a consolidation phase, which is fine because you have made some good returns. But I think selling too early, just exiting a stock because you didn't really see the big picture, right? And you were excited. Okay, well, I made 20%, I made 100% return in the stock, and you exited. I think looking back at times, okay, you would have said, okay, wish I would have held on to that stock.
That's right. Yeah. Yeah. Okay, my last couple of questions, and one of them, last three questions probably. I typically ask my guests, how do you detect fraud in a company? Is becoming more important with every passing day. You've already spoken about the importance of cash flows. Uh, any other like test you run through to detect fraud in a company?
So I think what we should do is also, I think, not just look at the numbers, but also look at the whole ecosystem, right? Company, okay, there are suppliers, okay, who are there to the companies, right? Or the company could be selling its product to some other players. So you do some kind of checks, okay, with your ecosystem partners in terms of just to verify whether some of the sales what they are reporting are really that okay, where there is enough. So you can get some lot of feedback also, right? When you talk to the partners and suppliers, distributors, which are there. Well, what are the practices the companies are following? Some of them ethical or unethical practices which are there. So I think that is one kind of a check, okay, which can help you to detect if there is some kind of a over invoicing, over reporting, or some kind of a fraud, which could be there. So I think channel checks are also important in terms of trying to verify certain details, which probably not there. I mean, balance sheet obviously is something which you would run through and look at some of the ratios, okay, which can talk about like cash flows, which you talked about, or even on the working capital side, right? How it is, how things
Yeah.
are getting locked over there. So I think that is, I think, another uh, way of trying to gauge some kind of
Yeah.
insights in terms of there are any frauds.
Yeah. Yeah. Uh, thoughts on asset allocation. How do you allocate your own personal assets? Property, gold, stocks and funds together. So because it's nearly the same thing. Uh, how
So
do you
I
keep?
think, I mean, I try to keep it very simple, okay? But I mean, I would not advise that to everyone because, uh, I mean, I mean, between debt and equity, if you look at, right, most of it is in equity because over a longer term, I believe that equities, and since you know, right, you know the risks what you're taking, and you've seen market cycles. I think bulk of it is besides for what you require. Say whatever you require for the next say 3 years, or if you have some large commitments, okay, which you want to keep aside. I think that money definitely you should keep into say fixed income, and there are various not just into bank deposit, but there are a lot of good products on the fixed income side or on the debt mutual side, okay, where you could put in where you can get the benefit of indexation also, right? Tax benefit which is there. But beyond that, I think I would tend to put everything into equities. Okay, I'm not talking about real assets. Okay, that
Yep,
is something
yep.
which is different.
Nice.
But I think it's also important to have a certain real assets. Okay, because that gives you some amount of output, and you're able to if you're able to get something real assets at a price. Okay, normally you can uh, unless you want to buy for consumption. But real assets, you can time it, okay, when the markets are down, right? Like, for example, if you're buying property, it's not necessarily to rush in to buy as an investment when I'm saying, but every asset class goes through cycles, right? We've seen that across, whether it is equity, whether it is property, whether it is gold, and try to play a bit contra there,
Okay.
right? So especially even investing into property when it is going to a downturn, and uh, when the prices okay are fairly attractive, or when interest rates are low at that point in time, that's a good time to really invest into real estate, because and that's the point in time where you can actually not necessarily sell okay your investments and buy that. You can, and normally in downturn interest is also very low,
You
so
can
you can
leverage.
actually take advantage and take leverage, right? To be able to, because that time you might not want to liquidate some of the assets because they might also be going through that downturn, right? Sometimes when the economy is down, your equity is also down, property market is also down. So I would normally try to play counter-cyclical over there, right? Okay, be a bit contra, buy when the assets class is going through a particular down cycle, and especially in property, for example, if you are able to leverage that, right, and when the interest rates are low, you can take that leverage and then at the appropriate time try to use that. Right? So yeah, so I think, and gold is something which normally I would not. You can have some investments over there, but very small. I don't have much fascination for gold.
Mm-hmm.
Uh, it can be. Normally as a part of an asset allocation, we always say that at least around 10% can be into gold. It's a good hedge.
Yep.
So gold is a good hedge okay, during crisis, because that's where it appreciates. It gives a good stability to the overall portfolio. If you look at the
Does
overall
that view on
portfolio.
gold go down well at your home about not having much gold?
So whatever you require for consumption, right?
Yeah,
Okay,
the
if
jewelry.
you are like jewelry, whatever, that is fine.
Yeah.
But as in investments, normally somehow I have not been able to really uh, uh, had a lot of fascination for gold or whatever, because I don't know how to really place that.
Yeah.
But yeah,
Yeah,
gold
I
also.
get that. Yeah.
But gold also you can play it slightly counter-cyclical, right? It also goes through its own cycles. Over longer term, we've seen that gold has given around kind of a 9% kind of a return, 9 to 10% return. So which is also not bad. Okay, looking at what you could get into, say, the fixed income side. But I would make it simple. Keep it equity, large part of your financial investments into equities, right? And apart from what you require over the next 3 to 5 years, okay, that you can keep it liquid and everything. And the rest, buy property, okay, during down cycles, right? And yeah, and try to not necessarily dip into your investments, okay,
Yeah.
when both the cycles are down, and take some leverage and then repay that out.
That's a great idea. You have children? One kid, two
Yes,
kids.
yeah, I got 2 kids here.
How are you teaching them about money? Or have you
So
already been through the cycle, or you're in the cycle? I don't know where you, with regards to your kids, about teaching them about money.
yeah, so teaching people about money is first of all trying to really manage their own expenses, so giving them some independence, right? So giving them some money, okay, so that they know, okay, what to spend, okay, where to spend, okay, what is the value of money. I think is something which is one can start off with, and giving them a budget, right? That this is the amount which I'm giving, right? This is the amount you need to spend, and then they can take their own decisions, right? What is rational? Okay, they need to value, okay, what they are spending money. Otherwise, if money comes easily, okay, then the value for that doesn't really come in. So they need to appreciate what price they are paying for a particular good or particular service, whether really they're getting value out of that, and whether it's necessary really at that point in time. So giving them some budget, but that is the initial years. I think as they can grow older, right, and I think you need to give them some exposure, right, investing, either into say mutual funds, right, for example, because directly investing into stock is not necessarily always an option. Like for example, being into the fund management side is not something which you can have the liberty to invest directly into stocks. But uh, I think and there are various other ways, right, which you can teach them, okay, to start making some investments, small investments. I think if you start early, right, and that's the beauty about investing and the power of compounding. The earlier you start investing into whatever equities, the better it is, because the power of compounding. Okay, if you see, like for example, if you invest something early at the age of say when you start getting your first paycheck, right, which could be the age of whatever, depending upon 23, 25, whatever, then you have almost like next 25 years, right, to put that before, or 25, 30 years. And if you are able to, I mean, invest into equities, and then if you're able to compound your this thing at 20%, then over 25 years, that 1 rupee can become 100 rupees, right? And that's the power of compounding. And many people start to invest much later. Like initially, your savings, what you have, what you want to spend that, and that's normally when you're young, you want to spend that in a lot of luxuries or whatever.
That's the
So
irony. Mhm.
yeah,
Mhm.
so I think, but you should start making even small investments at an early stage. I think that will tell you, okay, the power of money and the power of compounding. And you can obviously you will make some mistakes also, okay, when you are investing, but you learn that early in your career rather than later, right, when your stakes are much higher.
And you know what happens is if you don't start early and you see people who started early starting to make money, then you're tempted to correct that mistake. And unfortunately, people try and correct that mistake at the top of a bull market.
Right.
That's the time they're open to all ideas, and that's where wealth's lost. So on a lighter note, you said you give your children a budget. Are they running a deficit or a surplus?
It doesn't matter really, actually, as long as, okay, you control that, right, okay,
Yes.
what amount, okay, and they'll also make
Revised
their
budget,
mistakes
the
when they learn.
revised budget, revised estimate, revised budget going on.
Right.
Okay. Any thoughts on giving away wealth, charity, etc.? What are your thoughts on that?
Yeah, I think that is, I think, equally important that down the line you start whatever initially you are trying to create wealth. Okay, that's what it seems, because you don't know how much is enough. But I think down the line, I think it's important to, okay, once you have enough, okay, to take care of your needs, okay, then to give back to society and give. I think it's important to do that. I think everybody needs to contribute. Only thing is, how do you have enough time to see that what money you're giving out, okay, is also going in the right direction, right? So you need to have some time or some oversight on that. Is also very, very important, because it's your hard-earned money and you want to go into the in the right area, the right causes, right, which are there. So I would say that I mean, individuals would have a different kind of a philosophy over there, but I think say around 10% at least, no, of your incremental listing is something one should start looking at, in what ways you can start contributing and giving back to society, and if possible, try to increase that. But at least that is something which I think, as over a period of time, okay, once a lot of responsibilities and other things which you have taken care of, I think I would definitely advise and start looking towards that. I think because I think beyond a point, money has only limited value, right, for you, right? But if you're able to really give it back and help others, I think that gives a lot of satisfaction and joy. And if you're able to relate to a particular cause, right, and work towards that, I think you can probably get much more satisfaction.
Yeah. If you don't mind my asking, any particular cause that you're close to and that you're working with and helping with?
Yeah, so I'm actually trying to still work on that, but I think especially for old people, right? Okay, old age people, because that's where some of these people require a lot of attention, and that's one cause, okay, which is there, right? Cancer again on the other side. Okay, cancer is something which is in an area which is, I think there are a lot of patients, okay, which are in fact not able to get the right kind of uh, treatment. So that's another cause, okay, which I am pursuing.
Okay, wonderful. Thank you for sharing so personal stuff. Thank you very much for that. So, my last question to you: talk to us about how much you read, and what you would recommend to our viewers to read.
I think reading again, I mean, ideally, I would like to say at least read one book in a month, but it's not always possible, right? But earlier I used to read a lot of fiction, but I think now I try to read a lot of stuff which is much more topical, some autobiographies, something which inspires you, and at times also some interesting books on investments, okay, which is always interesting to learn, okay, from investors, okay, from their past experiences, and so those are the things which normally I would try to read, but nothing in particular, something which really excites you or what you find engaging is what I would look at. Uh, Nowadays, I read less of fiction. Okay, that was earlier, but I think it all depends on individual choices, right? What you want to do. I mean, for an investor, I think you can start off. There are a lot of books now which are there, right, which would give insights. And again, investing principles, what was relevant 50 years back is relevant even today, right? So learnings which are there in markets, they don't really have changed. The behavior of people doesn't really change much. So a lot of books on behavioral side, okay, which I would like, because that's where you need to uh, also shape up, right? Those are the books which normally I would form. But again, it's a vast diaspora. I think each one needs to find what he's comfortable, what he likes. And reading is sometimes also pastime, not necessarily
Yeah,
just to always gain knowledge, right? It's just a kind of keeping yourself engaged and some kind of a distraction from a normal day-to-day work which you do.
sure. And uh, related to that, because you mentioned macro and global macro earlier, do you track global media, any global publications you stay in touch with, just to get that input on what's happening around the world at a little more granular level?
I think being at my position where I'm there, I think there's a lot of stuff which you get, right, across. So there are, like, for example, there's a BCA which is there, right? Reports, okay, which we get, which gives a good insight in terms of global macro. What are the global trends? What are the asset allocations you plug in? Which are the sectors? So that's one clearly, but it's a paid subscription, right? So being a part of this field, I think that's one thing. But otherwise, Economist, for example, right, which is a fairly good magazine, right, which gives you a good for anybody to get insights into what's happening globally. And there are very good articles, okay, which talk about certain themes, right? Or it's not just about economics, but it's also about certain themes or new technologies which are coming up, which gives you good insights of not only investing macroeconomics but emerging technology trends. So I think that's I think a good magazine, okay, for anybody, for any person to really look at.
Yeah. Wonderful. Mahesh, thank you very much for making time for us. I know we took a lot of time and we had a little bit of glitches and all, that's fine. But very insightful, very thought provoking. I love the way you articulated your system for picking stocks for various kinds of companies. And I think this is going to be wonderful for the viewers. Yeah. I thank you very much once again for the time you made for us.
Thank you, Rahul. It was a pleasure interacting with you. I think we covered a wide range of topics. I think, and
We
it's
did.
not just in investing. I think it was I have to really think at times, right, in terms of uh, get deeper into it. So I think, yeah, it was really a pleasure. Yeah.
And I guess you're truly surprised. I didn't ask you what's the outlook for the market, because I think if you get this right, the outlook is not that important. You'll have
But I
you.
think,
Yeah.
yeah, but I think if you, I mean, one, forget the outlook of the market, but I think what I really believe is that I think this is the time where it's time for India to really uh, come of age and take center stage. I think the next whatever 10, 20 years, if we are the foundation has been laid for India to really become a big, large economic power. A lot of things are falling in place. We've seen the whole reforms which we have done in the last 7 years. I think that is laying the foundation. We have huge demographics, okay, which have a large working population, which can be a big advantage and can be also a big bane if you're able to engage them. But the way geopolitics are changing globally, I think India can be a large supplier to the world, right? I mean, we've seen what's happened to China, right? And I think the way India has adopted digital, I mean, India, the adoption of digital has been at a very, very fast pace. I mean, we are not only suppliers of IT workforce to the world, but in India also we have seen that, and that will help us to improve our productivity. And this is going to be the more digital age. All these factors put together, I think you will see a very strong growth for India. I mean, it might not be as strong as what we had saw in the earlier case because global growth is not going to be as strong, but relatively, and that will provide a lot of opportunities. Okay, for and in a lot of entrepreneur. I think we've seen the whole startup ecosystem in India has also taken up a big shape, which is good. Okay, and there is a lot of capital. See, world there is a lot of capital, but that lack of growth, right? So you have the capital, and this is in India where the growth is, right? So you can able to attract that capital and create jobs. So I think it's going to be a very exciting period for India in the next decade. Obviously, there has to be political stability, which is very important because a lot of this requires driving from top in terms of policies, agendas, which should be on course. But I think I have no doubt in my mind that India can will be one of the fastest growing economies, and it will be not late where you will be the third largest economy. I think that should happen in less than the next 10 years. So if that happens, automatically markets will do well, right? The
Yep.
economy does, then companies will do well, the earnings will grow, and the markets
Yeah.
should
And,
do well.
yeah. And the companies will grow. And when you are identifying companies to buy, remember growth at reasonable price. Remember all that Mahesh has told you today when you're buying companies. So that's the message to the viewers. There's growth ahead, but don't buy growth at any price. Buy it at the right price. Don't buy quality at any price, right? You mentioned that also. So follow the process. There's a tailwind, if I may say so, and you can ride it reasonably well, and good times ahead. Mahesh, thank you very much once again.
Thank you.
Great.